Money FM 89.3. Best of breakfast. The bigger picture, only on Money FM 89.3.
Thank you for joining us on the Bigger Picture Money FM 89.3. I'm Ryan Huang, and we are seeing some green on the screen so far as markets take a bit of a breather, a bit of reprieve with what's been going on the tariff front. And that is begging the question right now, is the worst over for the market turmoil? And to help us out, perhaps with some answers, we've got Thomas Rupf. He is the CIO for Asia at VP Bank. Thomas, good morning. How are you doing today?
Good morning. I'm well. Thank you for having me.
Yeah, great having you on. And it's been quite a year for you, I imagine, because it's been all about tariffs almost since the start of the year. How has it been for you, professionally? You've been tracking markets for so long. What has this year been like for you?
Well, it has been a busy year, especially navigating through the markets with all the noise since tariffs are changing almost on a daily basis, right? I think that's really key to really inform our clients what's noise, what's not noise, how to look through what's ahead of us, especially with fundamentals detached from the market at the moment. Right?
Yeah, I imagine more questions for you this year than most. What have been some of the questions? What are they worried about?
Well, they're mostly worried about, I think it's clear, the recession scenario, and especially with tariffs, Asia being the exporter to the world. That's where basically the tariffs really have an impact, where our clients, especially entrepreneurs, are also worried, how do I navigate through these markets?
Yeah, so you have tariffs just disrupting so many things. People are not sure what's going on in the near future, how much to expand, how much to hire, and so on. But it does look like we are getting some sense of dialing back from Donald Trump, at least on the tariff front. He is reconsidering a few things. How you read this situation? Is the worst over for markets?
It's a positive sign that finally we also see some reprieve from the initial tariffs with postponements, cancellations. So basically we have to still muddle through for the next few months until we get more clarity, but at least it puts more a floor on it that the Fed, the Trump put is also coming in, which provides a bit more of a floor. But it doesn't mean that we are not going to retest the lows which we have seen last week. But at least it shows Trump is watching what the market reaction is, and more on the credit side than on the equity side. So that's what we have been seeing last week with the treasury markets.
Yeah, there was a bit of a scare in the bonds market. Interestingly, we saw a bit of a sell-off there. Is that a sign that investors are shying away from the U.S. economy, just taking bets that, no, that's not the place to be right now?
Well, I would not say shy away. I think we need to see where we come from, right? We have come through a few years of really exceptionalism. There was a lot of concentration in U.S. assets, from equities to bonds to FX. That's why it's more a bit of a reallocation, a relook at exposures itself. But we don't see that there will be a huge shift going away from the U.S. as the fundamentals. If you look at the underlying corporates, especially if you look at the earnings season so far, it has not been bad. So it's just the outlook, the guidance, where you see a bit of uncertainty, where the corporates don't want to provide much guidance, but the underlying market doesn't look too bad yet.
All right, Thomas, let's talk about that positioning from the start of the year. How has that changed for you? I know a lot of people were quite bullish on technology in the beginning of the year. How much has changed on that front?
On the positioning side, what we have been doing, we have reduced the overweight on U.S. equities to a neutral. That's also where we wanted to really get more visibility, what's to come. That's one part on the equity piece, where we really went to maximum diversification across the regions. At the same time, we have also closed the U.S. high yield position, which we had on the fixed income side, despite the yields being still high. But at the moment, we just don't want to go into it with a long position in high yield until the picture becomes clearer.
All right, so you're waiting for more clarity. In that sense, you're going neutral on equity. So where are you finding your place to park your money right now in terms of defense and safety?
On the equity side, I think what's important is really diversify across regions, and especially on the different markets. We look more at domestic markets, which are a bit less exposed to the tariffs. That's also, well, if you look into Asia itself, that's also where, if you look at China, large part of the revenue, it's all domestic. It's only about 3% of the revenues which comes from the US. Then you have other more domestic markets such as Indonesia as well, and also India, which are providing a bit more security there with the domestic market itself. And what you see is also we expect with inflation not really being the big issue in Asia, so we also see more disinflationary pressures coming in, and central banks are ready to cut. We have been seeing also the first ones to come in, where we also see central banks supporting it on the monetary side, and I'm also expecting to see some more fiscal to really support the hedge headwind which is coming from the tariff side.
Yeah, talking about those tariffs, what's your reading from the commentary from some of the earnings you've seen so far? We've seen the banks reporting. To some degree, they are quite worried about what's to come on the horizon. They've been quite cautious of how the U.S. economy is slowing down. Some are even mentioning the word recession. What's your reading? Are we in for recession?
Well, it's not our base case at the moment. So basically, we're still in the camp of we might still see a soft landing. That's also basically where we currently expect 2 Fed rate cuts to come by first one by mid of this year. So there we are not in the recession camp. If you look at also the numbers what we have been seeing last week from the payroll side, it's not that the job market is falling off the cliff. So you see the hiring slowing down, but we are not there yet. But as I said, the external factors really, it depends on Trump and the tariffs, but at least we have some reprieve with some dialing back. But we have to be honest, at the end, we are not going to the world we have been before. So tariffs, they will be at the highest level since more than about 100 years. So also there, even if we settle at a lower rate, so even if we settle at 15% overall effective tax rate, it's still having an impact on the consumers.
Yeah, talking about tariffs, to some degree, we are experiencing some inflationary pressures from tariffs, costs being passed down the road. And to that effect, some folks have been jumping on the gold bandwagon and looking at how it's been performing year on year. It's up 35%, year to date up over 20%. Is it still an opportunity here, you think, with how things have been playing out, all the uncertainty and backdrop? Is gold still a place to go to?
Gold had a tremendous run. So basically in our portfolios, we always recommend our clients to have an allocation of up to 5% of gold in the portfolio. At these levels, we will probably not be increasing the gold position at the moment. What's more important for us, we also added industrial metals into our portfolios to really diversify that alternative investment part of the portfolio. So we have about roughly 15% of alternative investments in our clients' portfolios, from gold to industrial metals to hedge funds to real estate, to really diversify from equities and fixed income.
All right, gold now near record highs at 3,220, and it looks like maybe the name of the game is to diversify where you can right now with all the tariff tensions and all the parts that could be moving down the road. And in conversation with us this morning is Thomas Rupf. He is the CIO for Asia at VP Bank. Thomas, thanks for your time and insights today.
Thank you.
Stay Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.